SpaceX IPO, the $175 trillion bet Wall Street cannot ignore. On May 20, 2026, Elon Musk did something almost nobody expected him to do. He filed a form with the SEC. That one document, 300-plus pages, just changed everything. Because SpaceX is going public. Ticker, SPCX. Exchange, Nasdaq. Target valuation, $1.75 trillion. Target raise, up to $80 billion. And here's the number that puts all of that into perspective. Saudi Aramco, the Saudi oil giant, set the world record for the largest IPO in history back in 2019. They raised $29 billion. SpaceX is gunning for nearly 3 times that. If this listing goes ahead as planned on June 12, 2026, it will instantly become the largest IPO in the history of the United States stock market, possibly the largest ever. But here's the thing. Behind the incredible story, behind the rockets, the satellites, the Mars ambition, and the Elon Musk mythology, there is a financial picture that every single investor needs to understand before they touch this stock. Because this is not a normal company, and this is not a normal IPO. Today, we are going to go deep. We're going to look at the real numbers, the revenue, the losses, the debt, the competitive threats, the governance structure, and the valuation math that either makes this the investment of a generation or one of the most dangerous momentum traps in market history. Let's start from the beginning. Section 1. What just happened? The S1 breakdown. On May 20th, SpaceX officially filed its S1 registration statement with the SEC. That's the document every company must file before going public. It discloses the real financial picture, often for the very first time. And for SpaceX, a company that has been famously secretive about its numbers for 24 years, this was a bombshell. Here's what we now know for the first time. In 2025, SpaceX generated $18.67 billion in total revenue. That is a 33% increase over 2024, when they brought in roughly $14.1 billion. Strong growth, no question. But here's where things get complicated. In 2024, SpaceX posted a profit of $791 million. In 2025, that flipped to a net loss of $4.94 billion, and it gets worse. In just the first quarter of 2026 alone, 3 months, SpaceX posted another $4.28 billion net loss on $4.69 billion in revenue. Think about that for a second. The company is nearly losing as much money as it earns in a given quarter. Now, before you close this video and assume this is another money-burning tech scam, hold on, because the reason behind those losses is critical to the entire investment thesis, and we are going to break it down piece by piece. But first, let's understand the structure of what you're actually buying if you invest in SPCX. Section 2. The 4 companies inside SpaceX. This is the most important concept in this entire video. When you buy SpaceX stock, you are not buying one company. You are buying 4 companies bundled together, each with completely different business models, risk profiles, and valuations. Company 1, the rocket business. This is the original SpaceX, the launch company, the Falcon 9, the Falcon Heavy, the forthcoming Starship. This is the business that made Elon Musk famous and revolutionized how humanity reaches orbit. In 2025, the space segment, which includes launches for outside customers, NASA and the Department of Defense, generated $4.1 billion in revenue, up just 8% year over year, slow growth for a supposedly revolutionary business. Company 2, Starlink, the satellite internet empire. This is where the real money is, and we are going to spend an entire section on this because it is, without exaggeration, the most important asset in the entire company. Starlink generated $11.4 billion in 2025, accounting for 61% of SpaceX's total revenue. Company 3, the AI division, XAI. In February 2026, Musk merged his artificial intelligence company, XAI, into SpaceX. That one decision is largely responsible for the billions in new losses, and it represents a massive, unproven bet on orbital AI infrastructure. In Q1 2026 alone, the AI division posted a $247 billion loss on just $818 million in revenue. Company 4, the Mars and future economy play. This one is the most speculative. Starship, point-to-point Earth transit, orbital solar power stations, a self-sustaining city on Mars. None of this generates revenue today, but it is the narrative driving a massive portion of the valuation. The S1 prospectus, Musk's vision document to prospective investors, claims that SpaceX's total addressable market is $28.5 trillion. And here is the staggering part. Of that $28.5 trillion in projected opportunity, SpaceX claims 93%, roughly $26.5 trillion, will come from artificial intelligence applications, not rockets, not satellites, AI. That is the bet Wall Street is being asked to underwrite. So let's go through each of these pillars one by one. Forget what you think you know about SpaceX. This is a telecom company that happens to build rockets. Starlink is the financial engine behind everything. And the numbers are legitimately extraordinary. As of February 2026, Starlink had surpassed 10 million active subscribers across more than 160 countries and territories. Let's put that in context. When Starlink launched its beta program in 2021, it had 10,000 users. By 2022, 1 million. By 2024, 4.6 million. By end of 2025, over 9 million. By February 2026, 10 million. And growing at somewhere between 750,000 and 1.5 million new subscribers per month. That is extraordinary user growth by any measure. But the revenue story is even more interesting. In 2024, Starlink generated approximately $7.7 billion in revenue. In 2025, that jumped to $11.4 billion, a 50% year-over-year increase. And the margins? This is where it gets genuinely impressive. Starlink's adjusted EBITDA margin in 2025 was 63%. For comparison, traditional satellite internet operators typically run margins around 20%. Starlink is running 3 times those margins. Why? Because of SpaceX's vertical integration. They build the satellites. They launch them on their own rockets. They manufacture the ground terminals. They manage the whole ecosystem. Every incremental subscriber added to an already deployed constellation costs very little at the margin. The infrastructure is already in space. You are essentially printing money at scale. In Q1 2026, Starlink's connectivity segment posted $119 billion in operating profit. That makes it the one and only profitable division inside SpaceX right now. But Starlink is not just about connecting people's homes in rural Montana. The B2B expansion is where things get truly exciting. Aviation. In 2025, Starlink's aviation revenue reportedly grew nearly tenfold. Airlines around the world have been signing up at an accelerating pace. The U.S. Federal Aviation Administration, the agency that manages American airspace, contracted with Starlink to upgrade IT networks across 4,000 terminals managing U.S. air traffic. Let that sink in. The backbone of American air traffic control is now running on Starlink. Maritime. An estimated 150,000 maritime vessels, from Maersk cargo ships to Royal Caribbean cruise liners, now use Starlink as their primary at-sea broadband. Maritime revenue is projected to reach $1.9 billion in 2026, a 55% year-over-year increase. Defense. Starlink powers communications for dozens of military operations globally. Its military-hardened variant, Starshield, is becoming the backbone of a range of classified U.S. government programs we'll get to in the defense section. Now, all of this sounds incredible. And it is. But here's the skeptic's question. How long can this growth last? And how defensible is it? Starlink currently controls roughly 65% of all operational satellites in low Earth orbit. It has a first-mover advantage that is genuinely significant. But competition is accelerating. Amazon's Project Kuiper has already launched over 300 satellites and is targeting a constellation of 7,700. Jeff Bezos is not going away quietly. OneWeb, now operated by France's Eutelsat, has over 600 satellites active, and China's state-sponsored Guowang constellation, currently at around 163 satellites, is aiming to build a mega constellation of its own. There is also a pricing pressure story nobody is talking about. The S1 disclosed that Starlink's average revenue per subscriber actually fell 18% between 2023 and 2025, from higher ARPU to roughly $81 per month. That means Starlink has been deliberately sacrificing revenue per user in order to grow volume. That trade works as long as volume keeps growing fast enough. But if subscriber growth slows, or if competitors start undercutting on price, the entire financial model looks very different. For now, Starlink is the single most important asset in this company. Full stop. In 2026, Starlink is projected to generate roughly $20 billion in revenue, accounting for 70 to 80% of SpaceX's total. Whoever owns SPCX is essentially making a bet on Starlink first and everything else second. Section 4. The rocket business. Monopoly or Mirage. SpaceX's launch business is genuinely dominant. By almost every measure, SpaceX controls the global launch market. The company successfully completed over 138 launches in 2024, and it is targeting approximately 170 launches in 2026. By comparison, the entire rest of the world's commercial launch industry combined struggles to come close. Reports suggest SpaceX controls over 80% of global commercial mass to orbit. That is as close to a monopoly as the aerospace industry has ever seen. And critically, this dominance was built on a structural innovation that permanently changed the economics of spaceflight: the reusable rocket. Falcon 9 boosters now routinely land themselves back on drone ships in the middle of the ocean after launching satellites into orbit. Some of those boosters have now flown more than 20 missions. The cost implication of that is enormous. Traditional rockets were single-use. Every launch meant building a brand new vehicle from scratch. SpaceX reuses the most expensive component, slashing the cost to orbit by an order of magnitude. But here is the honest picture. The launch business, despite its dominance, generated only $4.1 billion in 2025. That's up just 8% year over year. It is growing slowly, and it has far lower margins than Starlink. Elon Musk himself acknowledged in February 2026 that NASA represents only about 5% of SpaceX revenue. The rocket business is the reputation, the moat, the logistics spine that enables Starlink. But it is not the growth engine. The growth engine, the thing that justifies the valuation, is everything built on top of the rockets. Which brings us to the most important and most risky development of the last 12 months. Section 5. The XAI Wildcard. Game changer or money pit. In February 2026, Elon Musk did something that shocked even SpaceX's most dedicated followers. He merged XAI, his artificial intelligence company behind the Grok chatbot and the Colossus supercomputer, directly into SpaceX. The deal valued XAI at approximately $80 billion in an all-stock transaction, and the stated logic actually makes a kind of sense. SpaceX needs AI for autonomous flight systems, Starlink optimization, and satellite operations. XAI needed massive compute infrastructure and a balance sheet large enough to fund its ambitions. SpaceX had both. The long-term vision is even more dramatic. SpaceX is now seriously pursuing the concept of solar-powered orbital data centers, essentially giant server farms in space, running on infinite free solar energy, untethered from land-based power grids. Musk's stated ambition is to eventually launch 100 gigawatts of AI computing capacity into orbit per year. The S1 lays out a $28.5 trillion total addressable market, of which 93% is AI. If you believe any meaningful fraction of that is achievable, the current $1.75 trillion valuation looks modest. Here's the part that requires serious scrutiny. The AI division in Q1 2026 lost $2.47 billion on just $818 million in revenue. Over all of 2025, XAI burned through over $6 billion. Capital expenditure at SpaceX, the money being spent to build out this AI future, jumped from $5.6 billion in 2024 to $20.7 billion in 2025. Of that $20.7 billion in capex, $12.7 billion went directly to AI infrastructure. The company spent more on capital expenditure in 2025 than it earned in total revenue. Read that again. SpaceX spent more building things than it brought in from customers. Now, the optimist will say this is Amazon in 2003. Amazon burned money for years building AWS. Look how that turned out. The skeptic will say most companies that burn cash at this rate never reach the promised land. And right now, the AI models xAI produces, Grok, are not yet competitive with the market leaders in the largest segments of the $26 trillion opportunity they're claiming. The Motley Fool's analysis of the S1 noted that SpaceX's AI products appear not yet competitive in the largest portions of their own stated addressable market. There is also the Cursor deal. SpaceX signed a $10 billion collaboration agreement with Cursor, the AI native code editor, with an option to acquire the company outright for up to $60 billion. If SpaceX does not exercise that acquisition option, it must pay a $10 billion breakup fee. That means SpaceX either spends $60 billion on a software company or it writes a $10 billion check for nothing. That is an extraordinary level of financial commitment on a bet that hasn't yet proven itself at scale. And then there is the deal that arguably explains why SpaceX may have gone public right now. Anthropic, the AI safety company behind the Claude AI model and one of the most serious competitors to OpenAI in the market, reportedly agreed to pay SpaceX $125 billion per month for compute capacity through May 2029. Think about what that means. One of the top AI labs in the world is paying SpaceX's infrastructure division over $15 billion per year. If that relationship holds, and if others follow, the AI division's losses start looking very different. But this is all extremely early stage. Orbital data centers that don't exist yet. AI products still behind the market leaders. Regulatory approvals still pending. The financial commitment is real. The return is not. Section 6. The Defense Empire. The moat most people miss. There is a dimension to SpaceX's business that most retail investors consistently underestimate. The defense business. By 2024, SpaceX held more than $22 billion in active government contracts, spanning NASA resupply missions, classified intelligence satellite launches, and the Starshield program. Starshield is the militarized version of Starlink. Encrypted links, optical inter-satellite communications, missile warning sensors, target tracking payloads. And in the last 3 months, SpaceX has dramatically deepened its position in the U.S. defense infrastructure. The U.S. Space Force just awarded SpaceX a $2.29 billion fixed-price contract to build what is called the Space Data Network Backbone, the communication spine for the Trump administration's Golden Dome missile defense initiative. To translate, Golden Dome is America's next-generation missile defense shield, an attempt to create a space-based system capable of intercepting cruise missiles, ballistic missiles, and hypersonic threats before they reach American soil. SpaceX now owns the communications architecture that holds the whole system together. That is not a peripheral contract. That is foundational infrastructure for what may become the most expensive defense program in American history. SpaceX also received a $178.5 million task order from the Space Force to launch missile tracking satellites and is part of a $3.2 billion pool of contracts for space-based missile interceptors alongside Lockheed Martin, Northrop Grumman, and Anduril. The defense business does several things for SpaceX's investment case. First, it provides guaranteed revenue that doesn't depend on subscriber growth or AI commercialization. Second, it deepens the relationship between SpaceX and the U.S. government in ways that create very high switching costs. Once the communications backbone of national missile defense runs on Starshield, that is not a contract you lose to a cheaper competitor. Third, it creates a compelling narrative for institutional investors who want exposure to defense tech without betting purely on traditional aerospace giants like Lockheed and Raytheon. The fair criticism here is that government dependency is a double-edged sword. Political relationships change, administrations change, And SpaceX's deep ties to Elon Musk's political activity and his role in the current administration through Doge creates a very unusual risk profile where the company's government contract pipeline is intertwined with one man's political standing. We will come back to that. Section 7. The valuation. Is $1.75 trillion actually justified? Now we get to the hardest question in this entire analysis. Is this company worth $1.75 trillion? Let's run the math honestly. At $1.75 trillion and $18.67 billion in 2025 revenue, SpaceX is priced at a price-to-sales ratio of approximately 109 to 116 times trailing revenue. That is a breathtaking multiple. Let's compare it to some benchmarks. At its IPO in 2020, Snowflake, one of the most hyped software IPOs in recent memory, listed at roughly 100 times revenue. Airbnb listed at approximately 30 times revenue. Even Nvidia, a company that dominates AI chip infrastructure and has become synonymous with the entire AI boom, trades at roughly 30 times forward revenue at its peak. SpaceX, at its IPO price, would be priced at 58 to 65 times forward 2026 revenue, which analysts estimate at $27 to $30 billion. That is still more than double what Nvidia commanded at the peak of its AI hype cycle. So what justifies it? The bulls have three core arguments. Argument 1. Starlink is a recurring revenue monopoly with 63% EBITDA margins. If Starlink reaches 100 million subscribers, a number that sounds aggressive today but is not crazy in a world with 8 billion people and 3 billion still underserved by broadband, the revenue could scale to $100 billion per year or more at world-class margins. At that scale, $1.75 trillion looks cheap. Argument 2. The defense contracts create a durable, high-margin baseline. Companies with government infrastructure contracts trade at significant premiums in public markets. The Golden Dome contract alone positions SpaceX as a critical national security asset that typically commands a valuation premium. Argument 3. The AI TAM is real, even if early. The convergence of satellite infrastructure, AI compute, and direct-to-cell connectivity represents a genuinely novel market position. No other company on Earth controls the satellite layer, the AI layer, and the launch layer simultaneously. If even a fraction of the $28.5 trillion TAM materializes, the current valuation is modest. The bears also have three core arguments. Argument 1. The company is burning cash at an extraordinary rate. SpaceX posted a $4.9 billion net loss in 2025. In Q1 2026, the net loss was $4.28 billion. The accumulated deficit since founding stands at $41.3 billion, and CapEx in 2025 exceeded total revenue. This is not a company with healthy near-term finances. Argument 2. The AI bet is unproven and expensive. The Grok AI model is not yet competitive in the most lucrative segments of the AI market. The orbital data center concept is science fiction at commercial scale today, and the xAI merger has injected billions in new losses into what was, at the Starlink level, an actually profitable business. Argument 3. The valuation assumes dominance across multiple trillion-dollar markets simultaneously. History suggests that very few companies successfully dominate multiple entirely different industries at once. SpaceX is being priced as if it will win in satellite internet, AI infrastructure, defense, and eventually the space economy. Execution risk across that breadth is enormous. The polymarket prediction markets, as of late May 2026, give a 72% probability that SpaceX closes above $2 trillion after the IPO. That is a remarkable level of market confidence. But markets have been famously wrong at exactly this level of confidence before. Section 8. The governance problem. One man, all the power. This might be the single most underreported issue in the entire SpaceX IPO. When you buy SPCX, you will own shares, but you will not own influence. Elon Musk controls approximately 42% of SpaceX's equity. But through a dual-class share structure, where his Class B shares carry 10 votes each versus 1 vote for the public Class A shares, Musk controls 85.1% of all voting power. Let me translate that into plain English. You can buy as many shares as you want. You can organize millions of shareholders. You can hold proxy votes and write angry letters. It will not matter. Musk can unilaterally approve mergers, acquisitions, executive compensation, new share issuances, and strategic direction. Under the terms of the S1, Musk can only be removed from the board or as CEO by a vote of Class B holders. He is the only Class B holder. This is not unusual in tech. Meta's Mark Zuckerberg has similar control. Alphabet's Larry Page and Sergey Brin maintained supervoting shares for years, but 85.1% is at the extreme end of the spectrum. Zuckerberg, at the height of his control, held roughly 58% of voting shares. And here's the specific risk that makes SpaceX different from Meta. Musk is not just the CEO of SpaceX. He is simultaneously the CEO of Tesla, the owner and CEO of X, the founder of Neuralink, the founder of The Boring Company, the founder of XAI, and, until recently, a senior advisor to the Trump administration running the Doge initiative. His attention is divided across at least 6 major enterprises, and his public conduct has a demonstrated history of creating violent stock volatility. Tesla investors know this viscerally. A single tweet has moved Tesla's stock price by double-digit percentages. His public statements about marijuana, cryptocurrency, and politics have all triggered SEC investigations and billion-dollar valuation swings. If Musk posts something that triggers a political firestorm, or if his relationship with the current administration sours, SpaceX's defense contract pipeline is directly at risk. There is also the political conflict angle that nobody can yet fully quantify. SpaceX is simultaneously the recipient of billions in government contracts and the employer of the man who ran the government's cost-cutting initiative. That relationship creates extraordinary leverage. It also creates extraordinary exposure, because political situations change. And when they do, companies built on political proximity can face sudden and dramatic reversals. Section 9. The 3 scenarios. Let's bring this all together with 3 honest scenarios for where SPCX trades over the next 3 to 5 years. Scenario 1. The bull case. Everything goes right. Starlink reaches 50 to 100 million subscribers. Revenue scales to $50 to $80 billion with 40% plus net margins. The defense contracts compound. Starship reaches commercial operational status, unlocking point-to-point Earth transit and ultimately lunar Mars missions. The orbital AI computing concept finds its market. In this scenario, SpaceX becomes the infrastructure company of the 21st century. The comparison is not to NVIDIA or Amazon, it's to both of them combined. A $3 to $5 trillion valuation within a decade is theoretically achievable. For investors who buy on IPO day at $1.75 trillion, this is a 2 to 3 times return at minimum. Scenario 2, the realistic base case. Starlink continues growing, but at a slower pace. Competition from Amazon's Kuiper forces pricing concessions. The AI bet takes longer and costs more than the market currently expects. The political situation around Musk and the US government remains complicated. SPCX lists, runs up on excitement, then settles into a trading range as the market demands earnings clarity. In this scenario, the stock probably compresses to somewhere between 1.2 trillion and 2 trillion over 3 to 5 years. That's not a disaster, but it's also a very bumpy ride for anyone who bought in during the IPO hype cycle. Scenario 3, the bear case. The XAI losses continue and accelerate. A high-profile Starship failure triggers regulatory scrutiny. The US government relationship with Musk deteriorates, and defense contracts are reviewed. Subscriber growth slows as competitors gain traction. At these valuations, bad news is extremely expensive. A 30% drop from $1.75 trillion is $525 billion of market value. Gone. This has happened before. Rivian listed at over $100 billion and lost 90% of its value inside 18 months. The IPO market has a long history of early retail buyers absorbing enormous losses while insiders exit. The difference here, and it is an important difference, is that SpaceX is a real business with $18 billion in actual revenue and positive EBITDA at the Starlink level. This is not WeWork. But at 100x revenue, you are not paying for what the company is today. You are paying for what it becomes. And that calculation has been catastrophically wrong many times before. Section 10. What retail investors need to know before June 12th. Let's talk specifically about the mechanics of this IPO for individual investors. In a typical mega-cap IPO, retail investors get almost nothing in the way of initial allocation. The shares go to institutional buyers, hedge funds, pension funds, sovereign wealth vehicles. SpaceX has reportedly structured this differently. According to the S1, approximately 30% of the offering is allocated to retail investors. At $75 billion in total raise, that would represent around $22.5 billion available to individual buyers at the IPO price. That is 3 times the typical retail allocation for a listing of this size. This is being spun as democratization. Musk giving the everyday investor a seat at the table. The more cynical read is this: the institutional demand, while significant, may not fully absorb the ask at $1.75 trillion. Retail excitement fills the gap. Something else worth noting. A 5-for-1 stock split was executed on May 4, 2026. This means the December 2025 private tender offer price of approximately $421 per share translates to a post-split price of roughly $84. This is almost certainly deliberate. A lower per-share price feels more accessible. It encourages retail participation, but the economics are identical. The total valuation is unchanged. 23 financial institutions are underwriting this deal, including Goldman Sachs, Morgan Stanley, JP Morgan, Citigroup, and Bank of America Securities. They will collect hundreds of millions of dollars in fees from this transaction. That is not a reason not to buy, but it is a reason to be clear about whose interests are being served by the IPO excitement. The underwriters need this deal to close. The insiders need liquidity. Early investors, some of whom have held SpaceX for over a decade, want their payday. None of that is wrong, but retail investors should enter with eyes open. Section 11. The one thing that makes SpaceX unlike anything else. I want to spend a moment on something that is genuinely hard to quantify. SpaceX is, at its core, a company organized around a mission that no other public company has ever attempted. The S1 prospectus states the company's purpose plainly: to make humanity multiplanetary. This is not marketing language for Elon Musk. He has organized his life, his resources, and his companies around this goal since the founding of SpaceX in 2002. The Starship, currently in its final development stages, is not just a rocket. It is the largest, most powerful launch vehicle ever built. Fully reusable, designed to eventually deliver 100+ metric tons to low Earth orbit per flight. Purpose-built to carry humans to the Moon and ultimately to Mars. If Starship reaches its stated performance targets at full operational maturity, the economics of space change completely. Satellite deployment becomes trivially cheap. Orbital infrastructure becomes affordable. Point-to-point Earth travel, New York to Sydney in under an hour, becomes commercially viable. None of this is priced conservatively. But it is also not pure fantasy. SpaceX has demonstrated engineering execution that its skeptics repeatedly claimed was impossible. Reusable orbital rockets, commercial crew transport to the ISS, a global satellite internet network with 10 million subscribers, a launch cadence that dwarfs every other operator on the planet combined. The history of SpaceX is a history of achieving things the consensus said couldn't be done. That doesn't mean every future bet will pay off, but it does mean investors should be cautious about applying traditional frameworks to a company that has already broken them multiple times. Conclusion. Is this the investment of the decade or the most dangerous momentum trade in history? The honest answer is, we don't know yet. And that honesty is exactly what the IPO excitement tends to suppress. Here is what we know. SpaceX has built one of the most powerful, genuinely innovative companies in the world. The Starlink business is real, fast-growing, and generating extraordinary margins. The defense contracts are deepening. The launch monopoly is real. At the same time, the company is burning cash at a pace that would destroy a lesser business. The AI bet is enormous and unproven. The governance structure gives shareholders virtually no recourse, and at 100+ times trailing revenue, the valuation requires a level of future perfection that almost no company in history has been able to deliver. The correct framing for this IPO is not, "Should I buy this great company?" The correct framing is, "At this price, with this structure and these risks, am I being fairly compensated for what I'm taking on? If Starlink hits 100 million subscribers, if Starship achieves sub-$100 per kilogram launch costs, if the XAI bet finds its market, if Elon Musk stays focused and politically stable, then yes, 1.75 trillion will look like one of the great bargains of the 21st century. If any of those major variables go wrong, and in a company this complex, the probability that at least one does is quite high. Investors buying at the IPO price could be waiting a very long time to see their money back. The space economy is real. The Starlink revenue is real. The potential is extraordinary. But extraordinary potential has been priced into extraordinary valuations before, and the market has a habit of being very unforgiving when the story doesn't move as fast as the stock. Whatever you decide to do with SPCX, do your homework. Understand the dual-class structure. Understand the AI losses. Understand the valuation math. Read the S1. Because this is not a company you should buy because Elon Musk is involved, or because rockets are exciting, or because Mars sounds cool. This is a company you should buy, if you buy it, because you have done the analysis, you understand the risks, and you have made a clear-eyed decision about what this stock is worth at this price. The $1.75 trillion bet has been placed. Now the whole world is watching to see if anyone collects. What's your price target for SPCX? And are you buying at IPO or waiting for the first dip? Drop it in the comments below. And if you want a follow-up video breaking down Starlink as a standalone investment case versus